So if you haven't been living under a rock for the past few decades, you'll be aware that passive investing through the use of index funds and ETFs has seen a meteoric rise and now makes up almost 50% of the total equities market. ETFs themselves have become even more popular, with them narrowly behind index funds by just a small margin now, making up over $7 trillion in assets. Both passive mutual funds and ETFs offer investors a selection of investments by using a single point to aim their money towards, meaning that it's now simpler and cheaper than ever before to own dozens, hundreds, and even thousands of companies without having to manually create your own investment portfolio. However, while that sounds great and that's a big win for new investors and experienced traders alike, with their rising popularity has also come a lot of competition. There are now hundreds and thousands of different index funds and ETFs which cover virtually every kind of asset class in every corner of the globe, which means that when you're starting out on this journey of investing, things can look pretty complicated. There are lots of different providers of these platforms, they all have really weird naming conventions, and some of them can even do something completely different than actually what you thought you were getting yourself into. However, it's not all that bad, and once you break down a few bits of key information, you'll be able to understand ETFs and index funds and find them for yourself like a pro. In the meantime, I've put together a list of some of the best index funds and ETFs that I can find on the market. Now, most of these will be available on all of your favorite investing platforms, especially if there are ETFs, but some of the funds might only be available directly with someone like Vanguard, for example. I'll give you their names, ticker symbols, and all relevant information so you can go ahead, do your own research, and start to build your wealth in 2022 and beyond. So let's start with some global options for you. In my recent Beginner's Guide to Investing, I gave a list of some of the best global index funds and ETFs that could be a cornerstone of your investing portfolio. Global index funds offer you a huge advantage over investing into individual stocks because they come with diversification built right in, meaning that they do not rely on the performance of one sector of the market or one region of the world. Now, inside a global fund, you'll typically see hundreds and typically thousands of companies which you'll own a very small slice of through that investment in the fund. Picked out a couple now which I'll pop on screen for you, and our quick point to note here is that global funds or ETFs are typically going to track the index as defined by one or two organisations, and those are FTSE Russell or MSCI. Now, because the options on screen now are all funds, remember that they're not traded on the stock market like ETFs are, so you won't find them on every platform. So you'll probably need a fully featured platform to find these, like Hargreaves Lansdown, AJ Bell, or Interactive Investor, someone like them. Now, one of the biggest advantages to funds, in my opinion, is that you can invest in them with whole amounts of money. So for example, if you want to invest £100 a month, you can do this and you won't have any money left over. Whereas ETFs are traded like stocks. So if an ETF costs you £94.50, then every month you'll end up with £5.50 left over, which might get a bit annoying, but you get the point. Now, if you do prefer to use ETFs for your investing, as you might imagine, there are also plenty of ETFs that cover the global market as well. So most of them are going to cover the exact same companies, but they have the ability to be traded on virtually any broking platform, including newer ones like Freetrade and Trading 212. Again, just like the funds, let me pop some ETFs up on screen now, the ticker symbols, so you can do your own research and look into them in a bit more detail too. To give you an idea of their performance, compared to some other indexes and how global fund or ETF might compare with a more concentrated one, see on screen now where I've used the HSBC MSCI World ETF and compared it to the FTSE 100 seen here in red and the Dow Jones Industrial Average seen here in orange. Overall, the trend for global funds, as you might expect, is positive, with the slightly lower volatility and slightly more conservative gains, whereas the more concentrated indices fall harder and rise quicker, but then have a lot less diversification built into them. Right, so that's some global options for you. Great for beginners if you want to get started and pretty much invest in something consistently over time. But what about some other major indexes and other markets which have also proven the test of time and ones you might want to look into for yourself? Well, we couldn't have a serious conversation if we didn't look at the next one, the S&P 500. The big daddy of all the markets, often used as a reference when people talk about the stock market itself. Now, beating the S&P 500 over time is seen as one of the most challenging things to do, especially as most professional money managers struggle to do this themselves. There are loads of funds which cover the S&P 500, giving you access to the 500 largest companies based in the US. Now, let me pop a couple of options up on screen for you now. It's worth noting that this index is one that Warren Buffett himself has committed to leaving his wealth invested into in his will. Fun fact for you. Many investors choose to invest in this as their sole index of choice. I also include myself as a sucker for the S&P 500. I can't get enough, and I've got a good chunk of my own stocks and shares ISA and SIP invested here. Make sure you check out the other videos on my channel if you do want to follow along some of the different portfolios I have across Vanguard, Hargreaves Lansdown and Freetrade. I think the results pretty much speak for themselves in this space. The US market is the largest in the world, and although the companies are headquartered there, a good amount of their income is actually derived internationally. So you do get a good amount of diversification both in the region itself and also in different company types. Over the past century, this index has delivered around 10% on average per year. So if you are able to ignore the noise of the news every day and ignore the price of Tesla stock, investing into the S&P 500 consistently over time is almost a guaranteed winner. The only downside with indexes like this, and this does also apply to the global ones that are passive, is that the weighting of your funds will always be aimed toward the largest companies. So the giants in the space are always going to be the ones you need to rely on and have the most power to move the market. The big tech companies are the real players here. Microsoft, Apple, Google, Facebook, and Tesla wield enormous power in this index. Speaking of technology, if you want to put a bet on the future of software, digital transformation, and electric vehicles, you might also consider the amazing performance of this next index, the Nasdaq. This index is one that has a heavy focus on stocks with a technology offering, which over the past few years have had a bit of a crazy ride, especially since the dip of 2020. Over the past 5 years, this index has performed over 200% growth, and over just the past year, we've seen the performance hit over 40%. The companies that feature on this list include Apple, Google, Microsoft, Nvidia, PayPal, Adobe, and Tesla, which we all know have had an amazing run over the last few years. The big question for investors, though, is can this kind of run continue, or are we heading into a bit of a tech bubble, similar to what we had back in 2000? Either way, that's up to you to decide and figure out if you want to be more tech heavy in your portfolio. If you want access to this index, then check out this popular ETF with the ticker symbol of EQQQ, which is the UK tradable version of the famous QQQ ticker symbol traded over in the US. Remember though, that pretty much every index fund is going to hold these companies within them. It's just that with the Nasdaq, you're going to be a lot more concentrated in this sector and won't have any other sectors like car manufacturers, airlines, travel companies, retail, etc., you name it. Like others, I'll be really interested to see how this market changes over the next few years if the big tech giants can continue to dominate the indexes and consistently deliver massive profits. Surely it can't go on forever, but I'm not going to be the one to try and time or predict the market. I'll leave that one to Kramer.
I'd be worried about Bear Stearns in terms of liquidity and get my money out of there. No, no, no.
Another major index worth taking a look at, also based over in the US, is the famous Russell 2000 index. Now, as the name suggests, this is an index of thousands of smaller companies who are publicly tradable, who don't quite make it up to those big leagues, but still could have a lot of potential. Over longer periods of time, smaller companies have tended to do better than their large cap counterparts, but they do come with a lot more risk and volatility, as they'll typically have less cash as they focus on growth. Anytime the market has any kind of uncertainty or a downturn, smaller companies tend to get hit the hardest as investors run to much safer bets like bonds, cash, or even the larger mega cap companies. In terms of performance over the last 10 years, this index has delivered an annualized return of over 14.5%. But just a word of warning, it's not all smooth sailing, and the volatility of the index means that you'll want to be in this one for the long run, if not just a short period of time. Because if we compare the last year's performance with its bigger brother, the S&P 500, we'll see that it's performed pretty badly. Just bear this in mind, but if there's something you want to look into, then there is a popular ETF you can research, ticker symbol IWM, to get access to that entire Russell 2000 index. Next up, I wouldn't be a UK finance YouTuber if I at least didn't give a special mention to the old dog sat in the corner of the room trying to get some attention from everyone petting their Shiba Inus and Huskies. Yes, that's right, the FTSE 100. This index tracks the 100 largest companies headquartered in the London Stock Exchange here in the UK. Now, it's a bit of a weird mix of stocks. There's no high-end technology or software companies leading the way, but it does have a few good points which might be worth you exploring. Firstly, it's a high dividend payout with a yield which nearly touches 4% per year. So if you need income on your investments, then this could actually be right up your street. Secondly, although it's a UK index, the majority of the income and profits of the companies listed here actually comes from overseas, meaning that you do get a good level of diversification across both sectors and geographies. Remember though that although this index has some pretty large companies, the UK market only makes up around 4% of the global stock market. So bear that in mind when choosing your investments, and be careful to consider how important future growth prospects are too of this index. Now, nobody knows where the growth is going to come from in the next decade, but as with anything in the investing world, diversification is most certainly your friend. So make sure you're using. Now for the grand finale, let me just touch on some interesting ETFs here for you that you may not have actually already heard of. Outside of the passive world of index fund tracking in the major markets, there lies a whole selection of actively managed funds operating in very specialized areas. So those ones are looking to take advantage of growth in very niche areas. Now, I did a video recently talking about these, but they are worth mentioning here for you now. These are mega trend themed ETFs. These are investments which track innovative sectors like electric vehicles, clean energy production, robotics and automation. And inside these investments are dozens of companies who share the same broad goal and operate within those specific sectors. So whether they supply the chips, provide spare parts, make batteries or produce cars, all of them rely on each other to benefit from the growth of the wider sector. If you're a bit more adventurous in your investing and you want to concentrate a bit more, but are not confident in your individual stock picking abilities, then this kind of ETF could be a good option for you, as you'll benefit from the specific areas of growth. Now, if you believe that they'll actually outperform the wider market. That's the question. There's no doubt areas like electric vehicles are the future and will have to generate renewable energy. But as with all things, are the companies in this space already overpriced, or do you think there's still a lot of room for growth? That one's up to you to work out and match up to your own investing risk tolerance, and certainly matching up with your own goals too. Anyway, as I leave you with that, thank you so much for watching. Please drop me a like if you enjoyed the video, subscribe for many, many more. I will see you in the next one, and as always, happy investing.